Credit cards are one of the most debated topics among financial planning professionals. When talking about people in their 20s, it can be extremely dangerous to use credit cards without knowing how they work. Credit cards can easily switch from being, oh, look, a free 12-month 0% financing payment plan for something that I need, to, oh crap, I have $100,000 of credit card debt at 27%. I'm going to have to file for bankruptcy, and I may get evicted from my apartment. I'm not a financial expert, and I'm not accredited. Not yet, anyway. Don't take anything I say as gospel. This is just me talking about my experiences and what I've found to be true. Before I talk about the best credit cards for beginners, please, please, please do not even think about using them until you know how they work, and how interest works. And if you know you're not somebody who can be trusted with a line of credit, then you should not use credit cards, period. Now, with that out of the way, let's get into the best credit cards for beginners and how to build a good credit score. And this is why credit cards can benefit you. Credit cards on the opposite side of the spectrum offer you some benefits that can help you out in the long run, particularly when you go to buy a house. So one of the main considerations that banks look at when determining if they can accept the risk of approving you for a mortgage and loaning you large portions of your money is your credit score. The FICO credit score is a simplified metric for finding out the trustworthiness of a borrower. FICO scores do not show the whole story, though. Typically, you also need to show proof of income, amongst other things, when applying for something like a mortgage. But a good FICO score is like a first step qualifier for getting the best interest rates on loans. FICO is not your friend, however. FICO is not causal in the 2008 American economic crisis, but they were not inconsequential. In 2008, banks were deceitfully rating borrowers of mortgages as better suited for the mortgages than they actually were. People with okay FICO scores were given extremely high mortgages under the assumption that, people pay their mortgage. Who doesn't pay their mortgage? The ratings agencies like Standard & Poor's, Moody's, and Fitch were aware of the fact that these people had lower tier FICO scores, but they still wanted to give these people mortgages because that's how these banks make money. So they were bundling these lower tier FICO people, lower qualified buyers, together in a thing called a CDO. And since there were so many people in a CDO, the liability through the rule of large numbers made it seem like the CDOs were safer than they actually were. They were having to make CDOs of CDOs near the end in 2008 because everything was so volatile. And a bellwether for being able to tell that people didn't have proper lending ability was the fact that their FICO scores didn't tell the whole story, or they had low FICO scores in general. Anyways, that was a little bit of a tangent. Let's get into credit cards, and let me tell you about the credit cards that I use personally to get a 760 credit score within a year of opening my first ever card. So first off, Discover Secure Card. The Discover Secure Card is made for people who don't have any credit. How secure cards work is that you actually provide yourself with a line of credit. You open the card and you deposit the $200 minimum you need. And then you just once a month buy like a water bottle or a Chipotle bowl or whatever you were already going to buy, and then pay it off immediately. 6 months later, you'll have a FICO score, and then Discover will refund the $200 you put down earlier. They'll then update your line of credit, and the card will now function as a normal credit card. From there, after you get your Discover deposit back, it'll probably be smart to find yourself an all-around 2% card. Unless you're lucky enough to have gotten the unlimited 3% Robinhood Gold card, then a 2% unlimited card is the normal path for proper credit card usage. You just use this whenever you go get groceries or go get gas or buy something you were already planning on buying, and never use more than 30% of the available credit you have at your disposal, and absolutely never miss a payment. The Wells Fargo Active Cash Card is excellent because it offers you a simple sign-on bonus. When you spend $500, you get $200 back, and then you get 2% back on everything you put on the card. I just recently bought $50 of groceries from Aldi on the Wells Fargo Active Cash Card, and because of that 2% back, it made my total bill $49. I know that doesn't sound like a big difference, but if you have a lot going on in a certain month, like you're moving, or you need expensive car maintenance, or you go on a trip, or something, that 2% can be really helpful, and it adds up over the course of the month. From there, those 2 cards are basically all you need to get a good FICO score, and you can get really good rates on mortgages and cars and whatnot just from proper usage of those 2 cards alone. But if you are an avid Amazon Prime user, the Amazon Prime Visa is excellent. This requires better credit, though, to get access. My friend got denied because because his FICO score was at 680 or so. I got accepted when my FICO was about 750. Those 2 cards are really all you need. No. The Amazon Prime Visa is from Chase, and the card is best for people who already are Amazon Prime members and spend a lot on Amazon throughout the month because it lets you get 5% off Amazon purchases. And once you already have a solid FICO and you're planning on traveling, if you feel like these travel cards, like the Chase Sapphire Reserve and the American Express Platinum, fit well into your lifestyle, then you can think about getting those, but their yearly fees are very expensive. And so make sure that you're going to be utilizing the rewards properly to get that yearly payment to be worth it.